Strategic budgeting planning for financial success. Introduction to budgeting. Budgeting definition. The process of planning future financial activities and allocating resources to achieve specific organizational goals. Core purposes of budgeting. Provide financial control and oversight. Plan for future operations and growth. Evaluate performance against targets. Coordinate activities across departments. Budgeting transforms strategic plans into actionable financial roadmaps. Types of budgets. Fixed budget. Remains unchanged regardless of actual activity levels. Examples: rent, insurance premiums, management salaries. Simple but less flexible for performance evaluation. Flexible budget. Adjusts with changes in activity levels. Provides more accurate performance measurement. Examples: materials costs that vary with production volume. Zero-based budget, ZBB. Starts from zero every period, requiring justification for every expense. Ensures all costs are necessary and justified. Rolling budget. Continuously updated with new periods added as current periods end. Budget components. Income components. Expected revenue from sales and services. Other income sources like investments or asset sales. Expenditure components. Operating expenses for day-to-day activities. Capital expenditures for long-term investments. Key distinctions. Capital expenditure, long-term investments in equipment, buildings. Revenue expenditure, short-term costs like wages, materials, utilities. Profit calculation. Profit or surplus equals total income, total expenditure. The budgeting process. Step 1. Setting objectives. Establish clear goals based on strategic plans. Define measurable targets for each department. Step 2. Forecasting. Estimate future sales, costs, and market conditions. Use historical data and market analysis. Step 3. Budget preparation. Create detailed budgets for each department. Coordinate between departments for consistency. Step 4. Approval and implementation. Management reviews and approves final budgets. Communicate budgets to responsible managers. Step 5. Monitoring and control. Track actual performance against budget. Take corrective action when necessary. Sales budget. Purpose. Forecast sales revenue for the budget period. Forms the foundation for all other budgets. Calculation formula. Sales budget equals projected sales volume times projected selling price. Practical example. Projected sales volume equals 10,000 units. Projected selling price equals $20 per unit. Sales budget equals 10,000 times $20 equals $200,000. Critical factors. Market conditions and competitor analysis. Historical sales trends and seasonality. Marketing and promotional activities planned. Production budget. Purpose. Determine production requirements to meet sales demand. Balance inventory levels with customer demand. Calculation formula. Production requirement equals sales units plus desired ending inventory, beginning inventory. Step-by-step example. Sales units equals 10,000. Desired ending inventory equals 2,000. Beginning inventory equals 1,500. Production requirement equals 10,000 plus 2,000 minus 1,500 is equal to 10,500 units. This ensures adequate inventory while avoiding overproduction. Direct materials budget. Purpose. Forecast material requirements to support production plans. Plan material purchases and inventory levels. Calculation formula. Direct materials needed equals production units times materials per unit. Example calculation. Production units equals 10,500 units. Materials per unit equals 5 kilograms. Direct materials needed equals 10,500 times 5 is equal to 52,500 kg. Additional considerations. Material purchasing schedules. Supplier reliability and lead times. Material cost fluctuations. Direct labor budget. Purpose. Estimate labor hours and costs needed for production. Plan workforce requirements and scheduling. Calculation formula. Direct labor hours equals production units times labor hours per unit. Example calculation. Production units equals 10,500 units. Labor hours per unit equals 2 hours. Direct labor hours equals 10,500 times 2 is equal to 21,000 hours. Planning considerations. Labor availability and skill requirements. Overtime costs and productivity rates. Training needs for new employees. Overhead budget. Purpose. Estimate all indirect costs supporting production activities. Plan for both fixed and variable overhead expenses. Calculation formula. Total overheads equals fixed overheads plus variable overheads. Example calculation. Fixed overheads equals $30,000. Variable overheads equals $5 per unit. Production units equals 10,500. Total overheads equals $30,000 plus $5 times 10,500 equals $30,000 plus $52,500 equals $82,500. Overhead categories. Utilities, maintenance, supervision, depreciation. Cash budget. Purpose. Forecast cash inflows and outflows during the budget period. Ensure adequate liquidity for operations. Calculation formula. Cash balance equals opening balance plus cash inflows, cash outflows. Example calculation. Opening balance equals $10,000. Cash inflows equals $50,000. Cash outflows equals $40,000. Cash balance equals $10,000 plus $50,000 to $40,000 equals $20,000. Critical 4. Managing working capital requirements. Planning short-term financing needs. Master budget. Master budget components. Comprehensive budget consolidating all departmental budgets. Creates unified financial plan for the organization. Key elements include sales budget as the starting point. Production budget based on sales forecasts. Direct materials and labor budgets. Overhead budget for indirect costs. Cash budget for liquidity planning. Budgeted income statement and balance sheet. Strategic value. Provides complete financial roadmap. Enables comprehensive performance evaluation. Variance analysis. Variance definition. Difference between actual performance and budgeted performance. Essential tool for performance evaluation and control. Variance types. Favorable variance, actual results better than budget. Adverse variance, actual results worse than budget. Example analysis. Budgeted sales equals $200,000. Actual sales equals $210,000. Variance equals $210,000 to $200,000 equals $10,000, favorable. Variance analysis guides corrective actions and future planning. Flexible budget variance. Flexible budget concept. Adjusts budget figures based on actual activity levels. Provides more meaningful performance comparisons. Calculation formula. Flexible budget variance equals actual results flexible budget. Example application. Actual sales equals $200,000. Flexible budget, adjusted for actual volume, equals $190,000. Flexible budget variance equals $200,000 to $190,000 equals $10,000, favorable. Benefits: more accurate performance measurement, better identification of controllable variances, zero-based budgeting process. ZBB philosophy: every expense must be justified from zero base. No automatic approval of previous period's expenses. Implementation process: review each department's activities and functions. Rank activities based on importance and value. Allocate resources according to priority rankings. Eliminate or reduce low-priority activities. Benefits: eliminates unnecessary expenses. Encourages cost consciousness. Aligns spending with strategic priorities. Budgeting advantages. Financial control benefits. Keeps expenses aligned with organizational goals. Provides early warning of financial problems. Planning advantages. Facilitates strategic planning and resource allocation. Improves coordination between departments. Performance evaluation. Provides benchmarks for measuring actual performance. Identifies areas needing improvement. Organizational coordination. Aligns all departments toward common objectives. Improves communication and collaboration. Thank you for watching. You now understand the comprehensive budgeting process from sales forecasting to variance analysis. These budgeting skills are essential for financial planning and control.